This conference is now being recorded.
Good afternoon. Welcome to the New York ASBO webinar, Bond and Debt Management. My name is Matthew Darius. I'll be moderating today's call. Your presenters for today are Mark Kozlowski and Mike Shizda from Financial Advisors and Marketing. If you have a question at any time for our presenters, please feel free to type your question in the chat pane on the right-hand side of your screen, or if you'd like to be connected to our presenters and speak with them over the phone, please hit number 7 and then the pound key on your phone. That'll notify me that you have a question, and then I can put you right through to either Mark or Mike. And without further ado, it's all yours, guys.
All right, thank you. This is our first webinar, actually my first webinar. I know Mike has done one other, and we appreciate this opportunity. What we'd like to discuss today is bond and debt management, but from the perspective of overall capital project planning, which would tie in with the two. The following will be a general overview of the important areas pertaining to capital projects. And as with any capital project, if you have been doing a capital project currently or have done one in the past or are planning one for the future, we advocate strategic redundancy. And that means getting all the team players involved initially to making sure everybody understands their roles. There is overlap in responsibilities, so there's checks and balances, and most importantly, sound financial planning, so that as we all drive towards the completion of a capital project, everything is wrapped up and it falls in line what we originally told the voters when we were planning for the capital project as far as capital impact and moving forward, which lays the foundation for a vision of trust for future capital projects. So we'll begin by an overview of the planning for a capital project. Obviously, with any capital project, community input and project ownership is very important. And a lot of this is just from my 25 years experience in dealing with school capital projects. We find this to be an excellent approach, especially if the school district is able to identify a prominent member of the community who is able to kind of take the forefront in speaking about the capital project and guiding this along. Oftentimes there's pitfalls with specific individuals that are currently within the school district taking ownership, and rather than doing that, developing a community-based approach towards developing a capital project. Obviously, in most recent years, the long-range plan that school districts are required to file every so many years has become an important component towards the capital project. And more importantly, with in regards to building aid, the capital project that's put forth has to follow that long-range plan, or there will be significant pushback from SED as to what would be aidable and what would not be aidable. It doesn't hurt to bring in the professionals early in the process, even in the conceptual planning for a capital project. And when I mention professionals, most importantly, your local attorney or bond counsel, the architect, your advisor, and perhaps a construction manager. And this importance will be evident in some of the succeeding slides that we will show. Obviously, the main goal in a pre-referendum and planning for a capital project is really identifying the scope of the capital project and ultimately what would be the net local cost to the residents, and making sure that the project is picked apart so that there is no assumptions as to what type of building aid would be received, what type of projects are being identified. And it's become more critical in today's votes going forward after July 1st, 2011, in that no building aid is going to be paid until the final cost reports are filed. So it's going to be very critical that all team members are in sync so that that paperwork can be filed on time and you can start receiving your building aid. Obviously, letter of intent is the kickoff form that's filed with SED. It identifies your project manager, a key individual at the State Education Department who is going to be assisting the district in not only identifying the work to be done, but also the type of aid that will be available to the district for each of the project buildings. The estimated debt service schedule projections are our key financial tool in developing the estimate of the local impact, and also help identify perhaps those buildings where there's pressure against what we call the maximum cost allowance, or the maximum aid that the district can receive against a particular building. It helps us identify and narrow the scope of the project. And then from a legal perspective, completing seeker is a requirement prior to referendum, making sure that that's done. And for certain district buildings that are of certain age, there's certain SHPO requirements, which are more or less for aged buildings, making sure that their historical nature is preserved. Again, planning for a capital project on the next slide, it's more or less a continuation. Each district is required to pass a resolution establishing the date of vote. Your bond counsel can guide you further in these steps, but a minimum of 45 days needs to occur prior to the referendum in which that resolution has to be passed. And as I briefly mentioned, the seeker requirement should be completed typically prior to establishing the date of the vote or passage of the resolution. So certain legal notices of special election have to occur. Public hearings are an excellent undertaking on behalf of the school district. Some school districts like to time public hearings with perhaps a big game, if you will, or an open house, so that you're drawing parents in of students who will be affected by a capital project, the likely yes voters for a capital project. And there are various publications and newsletters which typically go out. A lot of school districts will contract with their BOCES on marketing, or perhaps your experience has been you're familiar with the brochures, and you can just drop in data that will be familiar to your residents. Referendum outlines where, when, why, and the results. When you're holding the referendum, a lot of items have to be clearly stated, and the adoption of the bond resolution is a foregone conclusion after a successful referendum vote. And lastly, the publish of a notice of estoppel, so that after the bond resolution is passed, there is a 20-day period in which anybody has the right, as a last action, to stop a referendum. So from our perspective, there's three key legal requirements that have to take place surrounding a referendum. One is the resolution setting forth the date of the vote, which is basically the resolution that will allow the district voters the opportunity to vote on a capital project for the expenditure of monies on your capital project. The bond resolution, which is a separate legal action, is the authorization to borrow money so that you have money to spend on the capital project. Two distinct actions that are legal requirements. And then lastly, the notice of estoppel, as I mentioned, which has to transpire before any borrowing can take place. Key members of the capital project team include the architect, construction manager. If there are any special contractors that will be required for the capital project, could be included. Bond counsel, what we term in the industry now per SEC regulations as a municipal advisor, or a person that specializes in advising on municipal debt and state aid matters. The Securities and Exchange Commission has passed a set of rules and regulations that anyone who advises municipal debt in the United States has to be registered with the MSRB and SEC. So you have to make sure that your advisor has met those registration requirements. Oftentimes we find that the local attorney is involved, obviously district officials and the state education department. More specifically, the reasoning behind including these individuals, an architect is required by SCD for projects costing over $10,000, and they work closely with the district to determine scope and cost of projects. They prepare the project description, they help design the project, and they work with SCD facilities planning to get approval of plans and specs. Now, a little bit more on elaboration on those bullet points. An architect oftentimes are very proud, and they think they know quite a bit about building aid and how it's applied to capital projects. And this is where the strength and redundancy comes in. Your financial advisor should also be well-versed in building aid and capital projects, and they should be able to play off one another to make sure that they're both agreeing with the estimate of building aid, the estimate of maximum cost allowances applied to each capital project. As to the project description, we advise our districts to make sure that you keep the scope of the project and the description as broad as possible, so that if you find yourself with, let's say, leftover monies from a capital project, your bids come in less than expected, you are able to go back to the state education department and say, we'd like to do additional work, and therefore it's allowed under the project description because the description was broad enough. So the key here is to make the project description and also the proposition that's in front of the voters and all material as broad as possible to give you flexibility to do as much work under the referendum as you can. Also, another point is that we are recommending in today's day and age that every district has a conversation with its project manager along with the architect and perhaps your financial advisor. So again, everybody's on the same page as to the maximum cost allowance for each of the buildings and the building aid that's going to flow. Now, I've mentioned maximum cost allowance several times, but in summary, maximum cost allowance is the dollar value based upon the pupil capacity of the work being done in each specific building and the amount of aid that is available to be applied against your building aid ratio. So for argument's sake, let's say you want to do $1 million worth of work in building A. And based upon the number of pupils, your maximum cost allowance is $2 million. Then the state will aid you at your building aid ratio up to $1 million, or the amount of work that you're actually going to do in the building. If, however, it's converse of that, if you want to do $1 million worth of work, the maximum cost allowance only allows for $500,000, then effectively you're only going to receive half of your building aid ratio applied against the allowable cost for that building. So these are important factors to determine, obviously, prior to figuring out your tax impact and what you're going to disclose to the voters. The construction manager, or in the past used to be referred to as clerk of the works, works with the district and architect on the initial cost estimates and are significant in helping develop the project timeline and cash flow. Now, this is very critical to you as well as your financial advisor, because we're tasked with trying to estimate when the project will first impact the school district from a budgeting standpoint. So if you can envision, our first question is, well, when is the referendum? When do the plans, are they anticipated to be submitted to SCD? and what is the expenditure of the project going to look like so we can schedule out anticipated financing. And ultimately, and more importantly, after the latest changes to building aid, when is the project going to spend its last dollars so we can estimate when building aid will be received. All these factors help us to design a financial analysis for you so that we can discover what the estimated average tax impact is going to be to your residents. They also help determine the recommended contracts as far as how many bids will be let for each building. They manage the construction sequence and the contractors, and they provide the quality control on behalf of the district. Bond counsel, perhaps one of the most important individuals from an investor standpoint, because as you can imagine, at some point, if you haven't already, you're going to be selling tax-exempt municipal debt, whether they're in the form of bond anticipation notes or serial bonds. And the overriding factor from an investor is the significance of what we call the legal opinion as to the tax-exempt status. So if I'm an investor and I'm buying bonds from District A, I want to know that my investment is going to be tax-exempt. And the way I do that is I read the legal opinion from bond counsel, who opines on all the legal proceedings that occurred prior to referendum, and that each of the debt is issued legally, so that I can be assured that over the life of the note or 20-year life of the bonds, that interest that I'm receiving on that debt is going to remain tax-exempt. There is a myriad number of lawsuits that can occur if you don't have a qualified bond counsel. So making sure that they're on board early is critical to just make sure that all of the legal steps are followed properly so you can maintain that tax-exempt status. They must be versed in, obviously, local finance law, education law, the Internal Revenue Code, and the SEC rules. They often are referred to as having a Red Book recognition by underwriters and banks, which basically means that they've been doing this. You know, they aren't somebody that's turned the shingle and said, well, today I'm a property lawyer, tomorrow I'm a bond counsel. Obviously, as I mentioned, they prepare all the legal documents from both and provide the legal opinion as to the tax-exempt status. Financial and state aid advisor, your advisor should be not only versed as required under the SEC regs in issuing municipal debt, but as we know in New York State, very critical importance is understanding building aid, because it is the single most important factor for many districts in helping offset that local impact of a capital project. So as I mentioned, they must be registered with the SEC and MSRB. They're typically specialists in financial planning, state aid, and property tax impact. They understand laws impacting capital projects, and they really help coordinate all the financial activities amongst the bond counsel, the district, the architect, and construction manager. They assist in the packaging of what we call the official statement, or the marketing material to investors that outline your debt. That official statement is also a requirement of the SEC, which requires that annual disclosure take place for the life of the debt. And they are very critical in assisting with the building aid forms and filings with the state. Also, as a note, they've become more critical in capital project accounting and assisting the district so that when it comes towards the end of your capital project, that last expenditure coincides with filing the final cost report. Brief discussion on the State Education Department. The two key areas that will become prominent in a capital project are facilities planning and state-aided programs. You can consider facilities planning as the resource for all of the planning of the capital project in determining maximum cost allowances, issues regarding the plans and specifications, and then the state aid program side as resulting from, after a successful referendum, all the state aid filings that have to occur. So two distinct departments, but very critical in planning for a capital project. Some of the state aid forms you'll run into, I won't go into too much detail on each, but wanted to give you a flavor of some of the forms that you will be running across for any capital project. Obviously, the kickoff form is what we call the LOI, or letter of intent. It's a form that's sent by the district to facilities planning, where a project manager will be assigned to the district and a project number given to the district, so that all future correspondence can reference that number for ease of the project manager. So typically a project number entails a first subset, which identifies the school district, second subset, which identifies a particular building, whether it's the elementary or high school, and then a final third subset, which identifies the project that's actually being done, because with some buildings there's been multiple projects over the years. The letter of intent also details the scope of the proposed project, or follows closely a form. Voter authorization, the secret process, has to be identified and detailed. One of the more important documents is what we call the FPF document, or Application for Examination and Approval of Final Plans and Specs. It's a mouthful, but it's the first blush where the project manager is going to see the budget for a particular building and the type of financing that's entailed. So the type of financing will include how the district plans to finance it with bonds and notes, with budgetary appropriations, capital reserves, or with Excel aid. Some of the others are the SA4, identification and notification of building project, and for certain districts, the application for apportionment of building aid. If for those districts that might still enjoy reorganization building aid, this is an item that has to be filed for them. To continue with item number 7, the SA-139, request for project data, very critical. Once the FPF is filed with the facilities planning side of the State Education Department and the project is approved, then a second set of documents comes to the district, one of them being the SA-139. And after bids are let and contracts are awarded, the school district is tasked with filing the SA-139, which kind of trues up, if you will, the original budget with what has been awarded, so that the State Education Department has a chance to see, is the awarded contracts following what was originally envisioned in the budget. The FPFI allows for revisions between the two, between what was budgeted and the SA-139, another critical component. And then for those districts that are moving forward towards financing, something called the SA-130, cost allowance and bond percent for building aid purposes. So this is a checks and balance against what was originally discussed with the project manager and the district and the financial advisor as to what percentage of the project will be aided at your building aid ratio. So that if we're telling the public that you're going to receive 100% of your building aid ratio, the SA-130 will clarify that. If you're going to receive something less than that, then this is your opportunity to find out why. Change orders, an extremely critical component for most districts going forward. It's always been a critical component, but now due to the timeliness of filing their final cost reports and receiving building aid, the change orders we recommend be tracked so that first we identify who's responsible for filing the change order, who's responsible for tracking it at SCD to make sure that it's been approved. Because oftentimes we run into situations where we're trying to find or file a final cost report and we're chasing down change orders that have yet to be filed, that have for some reason been sitting in Albany because questions haven't been addressed. So it's going to be very critical to make sure that these are done in a timely manner. And then obviously, in today's environment, certificate of substantial completion becomes critical because everybody from the school district to the architect to the advisor has to know when that certificate of substantial completion is done. Because that, along with the final cost report, are going to be critical in getting those items to SCD to get your building aid flowing. The next two items, the SA-23 and SA-24, pertain to those districts that may be exceeding their debt limit from a certain perspective. Obviously, no district can issue debt if you're going to be exceeding your debt limit. But for certain districts, they are allowed to exclude their estimated building aid from the amount of debt to be issued, and that net amount is the amount that's applied against your debt limit. So that becomes critical for not only the school district and the advisor to file, but also for investors to know so that when they're looking at a school district investment that they want to buy, that they're assured that the school district will remain within the debt limit. Final building project report goes without saying. And then there's also a form that is common with school districts currently called an SA-135 or Bond Anticipation Note Schedule. It simply lets the state know the history of any notes that have been borrowed for a capital project. The next discussion centers around the New York State Constitution restrictions. And these are the set of laws we have to follow for determining the debt issuance, to make sure that we're not running afoul of any of these and advising the school district properly. So each school district, or rather each municipality or local government in New York State, is limited in the amount of debt that it can issue. And these rules fall under a constitutional rule on the outstanding debt. So for central school districts, it's the most recent taxable full value times 10%. For a city school district, it's the most recent 5-year average of taxable full value times 5%, which is stated in more detail under item number 2. And when we state full value, it's not the taxable assessed value, it is the full value after applying the equalization rates. The debt limit is calculated at the date of a given borrowing. So the debt limit that you have today might be vastly different from the debt limit that you'll have in 2 or 3 years as you are progressing towards your borrowing. So it's very important and critical for schools to make sure that their capital project and the potential for issuing any debt falls within that debt limit. Because we oftentimes, or I shouldn't say we can run into certain situations where you're within your debt limit today, but in 2 or 3 years you might not be within your debt limit. Especially for small city school districts, if they think at any point in their future that they might exceed their debt limit, then special proposition language has to be inserted into the referendum vote, identifying to the voters that at some point the school district may exceed its debt limit, and therefore you're asking for a supermajority vote to exceed that debt limit. That is very critical. Item number 7 goes back to the SA-24 building aid estimate. For central schools, if you think you're going to exceed your debt limit, there's a easy workaround, and that's applying for a building aid exclusion. Unfortunately, for small city schools, they are not able to apply for an SA-24 building aid estimate, and therefore they have to request from the voters authority to exceed the debt limit. Some of the local finance law restrictions. Each borrowing in New York State is governed by what we call the period of probable usefulness, or you may have heard the acronym PPU. It's a legal statement as to the maximum term that a school district can finance a capital project. Now, it doesn't strictly mean financing with bonds, nor does it strictly mean financing with notes. It's for any debt issued for a particular project. So it can be a mix of 3-year notes and 27-year bonds if it's a 30-year maximum. Most districts that receive building aid stipulate in their bond resolutions that they will take advantage of the 30-year maximum for repayment of debt, even though the district will only borrow for 15 or 20 years, dependent upon the aid stream to be received for a particular project. It's to allow the maximum flexibility for financing for a district. So if you can envision, you don't want the bond resolution to say, we're only going to finance for 15 years because we know we're going to get the aid over 15 years, because typically there's a couple years of note financing that takes place. So it might be 2 years of note financing and then 15 years of bonds, the way that building aid is paid nowadays. So you just want to give yourself the greatest flexibility and state a 30-year period of probable usefulness in your bond resolution. With regards to actually issuing the debt, with the first issuance of debt, a district is allowed up to 24 months after the date of the first borrowing in which to make a principal payment. And that's to make your first principal payment. Once you make your first principal payment, principal payments have to be made annually thereafter. So you have a 1-year window in which you can pay interest only during your first borrowing, and then it's annual principal payments thereafter. Now, most of the financing done in New York State nowadays is under something called substantially level debt. So you can look at it as similar to a car loan or a mortgage in that the annual debt service is level each year. And the reason we say substantially level, because unlike a car loan or a mortgage where you have corresponding principal and interest payments that go down to the penny, with municipal debt, you have to market it such that it's attractive to an investor. So in order to remain attractive and for the principal payments or the debt to sell easily, you need to sell the debt in $5,000, $25,000, $100,000 blocks. Doing so creates what we call substantially level debt approach, because you're not getting down to dollar principal payments. There's also something called the 50% rule. It's not used as often anymore as prevalent when I first started, but it basically allows for larger principal payments up front, but to such an extent that you're not paying the bare minimum. You're not making balloon payments at some point in the future. It's rarely used nowadays, but if you hear that terminology, it's a function of the local finance law. And we continue on to item number 6, which is on page 17. A little bit about the types of financing. Bond anticipation notes are short-term financing or notes issued in anticipation of bonds. We call them short-term instruments because they are typically a duration of 1 year or less. They are a critical component for alleviating the debt service pressures in the initial stages of a capital project. Because as you can envision, notes that are issued for 1 year carry a lower rate of interest. Also, New York State local finance law allows you to make the minimal principal payment during those initial years that would be much less than if you went right to bonds. It has to do with the function of the local finance law, which allows for making a minimum principal payment as though you're going to finance the project eventually over 30 years, when ultimately you may only finance it over 17 years. So the first 2 years might have very minimal principal payments, and then when you eventually issue bonds, because of the substantially level debt service approach, those principal payments balloon up, but enough to pay that debt off over the next 15 years. Typically, speaking to bonds, bonds are sold long-term instruments, so the rates are typically much higher in relation to the note issue. But they are typically sold for a corresponding number of years that equals the aid that's going to be received for the capital project. So, under education law, if you are doing a reconstruction project in Building A, that's typically aided over 15 years. Building B might be substantially an addition project, whose aid might be, or rather might flow over 20 years. So you'd want to sell a corresponding issue of 15-year bonds and 20-year bonds. Now, that doesn't mean you have to sell 2 issues of bonds. It just means that you overlap them and sell one set of bonds to the investor. But internally, you break them out so that they do, in fact, track those aid payments from the state. Bond principal payments are typically paid on the 1st or 15th of any month. And they are done so for investors because all debt is typically paid as far as interest to the investor on the 1st or 15th of the month. The other set of rules the advisor has to adhere to are IRS regulations and restrictions. There's something which we call the small issuer exception for interest earnings. To kind of step back and give you an overview, local governments enjoy paying a much lower interest rate than corporations and individuals because of their tax-exempt nature. The federal government instituted a bunch of regulations that basically said, well, if you're going to enjoy this lower tax, or rather this tax-exempt rate, then this money has to be spent in a reasonable amount of time. Meaning you can't sell your bonds today for a project that's not going to start 3 years down the road, because the federal government doesn't want you also earning a lot of money on those idle proceeds. So they instituted a bunch of regulations that basically said you need to track your expenditures and make sure that the debt that you issued and the proceeds will be spent in a reasonable amount of time. Every district and municipality has to track these. And that goes back to why we often request an estimated cash flow from your construction manager or architect. Because, again, it's a critical component that we follow to say you're going to spend $10 million over the next 12 months to 18 months, then we are recommending that you issue $10 million, and this is when it's going to be financed, this is when the debt's going to be due. Because we don't want you in a situation where you're issuing $10 million, yet you're only going to spend $3 million or $5 million, because then you really will run into problems with the IRS. So number one deals with a set of regulations that allow for districts to issue under what we call the small issuer exception of the interest rate penalty. It's important, and it's important for your advisor to explain this. When we say rebate, oftentimes there's a misconception that a rebate simply means if you've made more money than on the interest earnings than the rate at which you borrowed, then that's the money you have to pay to the IRS. It has very little to do with that. The calculations are based upon the amount of time you have the proceeds in hand in which you're making interest earnings, and that is the true penalty. So there are certain rules and regulations on what that penalty is, because again, it's simply not saying that I've borrowed at 1% and I've made 2% on my investments, therefore I net 1% rebate to the federal government. That's not how the rebate regulations read. The spend down test to make sure that you avoid rebate is that if you take the proceeds, you must spend 10% within the first 6 months of the date of borrowing, 45% within a year, 75% after 18 months, and 100% after 24 months. Now, there is a minor exception for what we call retainage that needs to be spent within 3 years. But for all intents and purposes, we breathe a lot easier if most of the proceeds are spent within 24 months. There is elections that your advisor should guide you on for whether or not you should pay a penalty or the amount of money that should be rebated to the federal government, and they work with your bond counsel to make sure that that box is checked after the proceeds are sold, or rather after the debt is sold. That form, called an 8038G, is typically in the realm of the bond counsel. They file that on behalf of districts as part of the legal proceedings after issuing the debt. The next discussion centers on education law and aid restrictions. Again, this kind of is working a little bit backwards, but it again merits redundancy, as we stated, strategic redundancy, so that everybody's on the same page. Building aid is obviously determined by the WONC, our state government, as a percentage of the school district's related property wealth and per capita wealth as it relates to a statewide average. So every district is given a building aid ratio, from 0%, and some might get the minimum 10%, up to a maximum of 98%. And we've worked with every type of district. And it's critically important because there's oftentimes a misconception that when you vote on the capital project or at the time you issue debt, the building aid ratio in effect at that time is the building aid ratio you'll get for the life of the debt, which is simply not the case. Your building aid ratio fluctuates from year to year, and your debt service, or your aid rather, is paid based upon your current building aid ratio. What we oftentimes express to the voters is based on education law today. This is the district's building aid ratio. Typically, the building aid ratio does not change drastically from year to year, but it can in fact change. So districts need to be aware of that going forward. Again, we highlight maximum cost allowance because we find this to be the most critical component of designing a capital project from a financial perspective. Again, the maximum cost allowance is the maximum cost that will be aided by the state education department at the district's building aid ratio. Any expenditure above the specific project building maximum cost allowance receives no aid and is therefore all local cost to the school district. And this is oftentimes expressed as what we call a bond percent or aidability, and that is verified on that form called the SA 130. So that after the SA 139 is filed and the district receives the SA 130, they'll actually see the maximum cost allowances by building, and you will see that your bond percent is either 1, meaning 100, or something less than that. I think I explained 5 and 6 or more. Well,
no, you did, yeah.
Yeah.
There you go.
All right, on to the issuance of debt. When we're planning out a capital project, it's important for us to understand, obviously, the key components of the project timeline. And those key components entail the date of the referendum, the dates of SCD approval, signing of construction contracts, and when the project's going to be complete. These components we use in designing and recommending when the district will be issuing its debt to the public and when debt service will start being paid by the district. One of the big components we receive to help us with this is a cash flow from the architect or construction manager. Again, we don't want to issue $5 or $10 million of debt if the project's only going to spend $3 or $7 million in the initial stages. We don't want too much debt to be hanging out there. Obviously, the budgetary considerations are very critical, especially with the property tax cap calculations. For most districts, and this is based on our experience, a capital project voted today is probably not going to receive building aid for 2, possibly 3 fiscal years. So if you can imagine a year from now, in all likelihood, your project's approved and you're starting to think about financing. Once that debt is issued, you're going to have some type of debt service within the first or second year. If the potential isn't for building aid to be received until the 3rd year, you're going to find yourself in a fiscal year with debt service and no building aid. So it's important for us to identify that, to discuss it with the school district to see what resources are available to mitigate that. Will it be a combination of interest earnings, reserves of some sort from the district, transfers from a particular fund, or what might be more prevalent for capital projects going forward, will there be capitalized interest as part of the referendum amount, which basically allows the district to borrow money to have debt service available to help pay debt service, or proceeds available to pay debt service. It's not the greatest financial mechanism or tool available, but in today's day and age, it might be the only mechanism available if the district doesn't have other revenues or resources to help offset that debt service with no building aid. On the issuance of debt, of course, is arbitrage or the sizing of the issue. We need an understanding of the soft cost or pre-construction costs. Those are probably the costs that give the district the most pressure prior to receiving project approval from SCD. And largely they are architectural fees because those fees are components of actually designing the project, creating the architectural plans to get them to SCD for approval. There might be interfund transfers from the general fund to the capital fund that might be required initially until monies can be borrowed. There's the discussion of notes versus serial bonds. There's the submission of plans and specs to SCD, and there's a receipt of the bond certificate. There's actually something called a bond certificate that the State Education Department issues to a school district after approval of the project, and it's a 8.5 by 11 sheet of paper. It actually says bond certificate, and it's more or less an insurance policy that you and the state have gone through all the procedures for the approval of a project, and it's okay to think about moving forward with the financing of a project. And typically, bond counsel requires a copy of that prior to allowing for any borrowing to go forward. The type of debt to be issued, I'll repeat briefly. Bond anticipation notes are what we call short-term instruments. They're one-year interest rates, typically in the neighborhood of 1% or less, much lower than bonds, which might be upwards of 3 to 3.5% currently. You know, I've lived through periods where one-year notes were anywhere from 5 to 7%. You know, my counterparts might have lived through years where, you know, note rates were 10, 12% back in the early 80s. These instruments are 1 year or less. They can be renewed legally for up to 5 years before they have to be converted to serial bonds. And just to give you an idea of the issuance cost, and these are issuance costs for all parties involved, advisor, bond counsel, legal requirements, are typically in the neighborhood of $6,000. For the issuance of serial bonds, they are long-term instruments. Rates are typically higher depending upon the term. There's no flexibility once the debt is issued, meaning you can't choose to make a smaller principal payment. You know, once the debt is issued, they typically have what we call call provisions or options of prior redemption, meaning after the first 10 years you could refinance the debt if interest rates are lower. The cost of issuance with a credit rating is typically in the neighborhood of $25,000. Now, a little bit about the way serial bonds are issued in New York State. There's two possible tracks. A school district can issue bonds on their own, or they can issue bonds through the dormitory authority of the state of New York, or what we call DASNY. The overriding factor in determining issuing on your own or through DASNY is determining what the school district's assumed amortization rate is. So, initially, once a project is approved, the state comes up with an assumed interest rate at which they'll aid the district's capital project debt. That assumed interest rate is based upon all the debt sold by school districts other than DASNY the previous 12 months through September of the year in which the project is approved by the commissioner. That's a mouthful. But suffice it to say, it's a very lagging interest rate that's used as an assumption rate. So a project approved today would be based on a rate in September of 2011, which was based on all the debt sold between June 30th of 2010 and August 31st of and July 1st of 2010 and June 30th of 2011, and not published until September of 2011, and typically it's published a couple months after September. So, that being said, as I mentioned, it's a very lagging rate. So, if a district thinks it can beat that rate based upon current interest rates, they would typically sell on their own. If a district thinks that they cannot beat that rate, then it would make sense to look at the DASNY financing as an option, because there's a stipulation in the education law which states that if the district issues bonds through DASNY, then the state will effectively pay that assumed interest rate at the rate at which they sold the bonds through DASNY. So you're more or less held harmless. And those are the two critical factors. Issuing on your own is without a doubt more efficient. You can issue when you want, have principal and interest payments when you want, and the cost of issue are significantly less. Issuing through DASNY is very time-consuming, onerous, and more costly as far as issuance costs. However, those issuance costs can be paid by a premium from the purchaser. The paperwork is mountainous by issuing through DASNY, but again, for most districts, the financial decision comes down to, can we match that interest rate that DASNY is going to offer us, or can we match it or beat it by issuing on our own? So those are two critical factors we need to look at. No decision has to be made prior to referendum. No decision has to be made when you're issuing notes. The decision really has to be made 6 to 9 months prior to your anticipated issuance of bonds, because the DASNY program requires that certain paperwork be filed starting 3 months before a DASNY issue. And unfortunately, DASNY issues have only been in June or December. So cycling your note issues to coincide with those is critical. The official statement, this is where the SEC gets heavily involved. Every investor has to have the opportunity to review a document which gives a financial history of the school district and outlines the legalities surrounding the issuance of the debt. If you're issuing over $1 million, this is a requirement. There's also the requirement that if you're issuing bonds, that a continuing disclosure document or a document similar to an official statement be filed every single year updating that information. Because if you're, in today's day and age, bonds are sold and resold continually throughout the life of the capital project. Therefore, the person that bought your initial 20-year bonds might not be the investor that holds the bonds in year 20. So in order to figure out the credit risk and the change in credit over that 20-year period, the SEC requires annual updates, notifying investors as to your current financial status. It includes a lot of economic data. It includes language that speaks to whether the bonds will be sold in book entry only form or if there's a fiscal agent involved. It also will stipulate on the front cover something to the effect of whether the bonds or notes are bank qualified. And basically what this means is that for a certain amount of money that's issued in a calendar year, banks might have the opportunity of buying that debt and taking an 80% carrying deduction on the cost of the interest expense. So it becomes a very attractive instrument for banks to buy, and therefore provides for a lower rate of financing than if they were not to D&Q. The official statement is typically distributed to banks and underwriters. We post all of our official statements on our website so that anyone has access to them. They also include the audits of the school district, or rather the most recent audit. They include language regarding insurance, litigation, rating agency disclosures, and again, continuing disclosures required annually. And that is an overview of bond and debt management, but also capital project financing as a whole. And I guess at this point, we'd entertain any questions that you have.
Okay, great. If anyone has any questions they want to ask, go ahead and hit the number 7 and the pound key on your phone. That'll notify me that you do have a question, and I'll put you through. We'll give you a couple seconds. Go ahead and do that. Okay, we have no questions. Mark and Mike, thank you very much for your support of this program. We appreciate it.
Glad I could be of so much help, Matt. No problem.
Well, great. Mark and Mike's contact information is right on the screen there, and it is included in your handout. So if you do have any questions after the fact, please feel free to contact them. Mike, thank you much again.
All right, take care.
Thanks a
Good
lot,
day.
folks. Thank you, everybody.